Well, Jurrien, how much of it is an inflation problem? How much of a problem that there's going to be an oversupply of treasuries issued because we're spending money like a drunken sailor?
Well, fiscal, a budget deficit of 5 to 6% of GDP 9 years into an expansion with an economy at full capacity, that is something that we don't see very often, and I think that's one of the reasons why the dollar is down, for instance. But ultimately, I'm not that concerned about the supply of treasuries. I mean, if we look at the 10-year, it's already doubled in yield from the July 2016 lows. That was at 1.3%. We're at 280, 285 now. And if you look at flows into bond funds and ETFs over the past 12 months, they're at a record high, 350 billion. So I think there's demographically enough demand for yield, whether it's from U.S. retirees or a Swiss pension fund. As the yields go higher, as they creep higher, I think there will be a bid for yield, anything that provides a yield. I think that the real issue really is valuation in the stock market, because if yields do rise, valuations are very high, in part because of the QE era, and I think that's one of the issues we saw over the last 2 weeks is that the PE increase over the last 6 months was unwarranted, and we gave it back in 9 days.
So, Jurrien, in a word, do you want to be short or long the 10-year at 8.29?
I think the 10-year near 3% makes sense here. That prices in 4 hikes, which is a hell of a lot better than it was 6 months ago when it priced in 1 hike. So I'm comfortable having exposure to the bond market at these levels. Maybe not 6 months ago, but for today, yes.